So I am Mike Thornton with Compass. I have a real estate team here in the Wheaton area, and I have some of my buddies, fellow professionals in the room here. We wanted just to put together a quick video. We're all getting tons of questions about the housing market, what it takes to plan for a purchase. We've had people that have been out of the market for some time that have come to us saying, hey, we don't even know where to start. So we have wanted to put together something for you as a resource. We have Daniel Westergaard of O'Connor Financial Group, Jack O'Connor. We have also of O'Connor Financial Group, and we have Jonathan Tink of Compass Mortgage. So here we are. We want to take you through a little bit of content here. So I can imagine, Daniel and Jack, you guys are fielding questions between the stock market, maybe crypto, the housing market. I mean, you are in the space where you're the first call, right? You're the first call. What do we do with our portfolio? We're trying to buy a house. What do we do? What do we plan for? What would you say are some of the questions you're getting from your clients right now?
Yeah, I think one of the questions we're getting on a macro environment is, hey, is the housing market going to cool off soon because equities have been selling off? And are we on the verge of a recession? Are we on the verge of economic slowdown at least? And if my portfolio is going down at the same time housing prices is going down, or is that necessarily a good thing? Or like you said at the beginning, people are kind of pausing right now and they're not sure, hey, is this still a good time to enter the housing market? So those are some of the questions that we're hearing on the front lines.
How about you, Johnny? What are you seeing out there? What are the questions you're getting from your clients?
Yeah, fairly similar. Maybe more specifically then geared towards interest rates, right? The big thing in the lending world is kind of like, hey, what can I afford? And then, sometimes it's lack of information, but that's one of the most easy questions that one is going to have. Well, what's the interest rate going to be? It's not great right now. And what is it going to be? Because, affordability is a little bit tougher. And, technically, is this a bad time to buy? I'm not sure. That's kind of the feeling that's leading to those questions.
Yeah. So, hey, Jack, kind of moving into a little bit of the content here is, how are you advising your clients as they come to you with the question of, hey, we're trying to plan for a home purchase. What are some of the things we should be thinking about? What are the next steps?
Yeah, it's a great question. So the core of what we attempt to do is to solve significant financial issues for clients and take advantage of significant financial opportunities for clients. And you'd be hard pressed for most people to find a more significant financial issue most of the time than purchasing a home. Whether that's the first home purchase or you have a family and you're going from the first home to the second home, regardless of what stage of your life you're in, it's a big step. And so we try to plan as much as we can as early as possible for this type of transaction, just because it affects so much of your financial life. It's not as simple as everyone on this call knows, calling up your realtor, Mike, and your mortgage professional, Johnny, to say, hey, let's move forward with this purchase. There's a lot that goes into it. And we try to look at these two things listed here on this slide. What will my cash flow look like after this purchase? And what does my balance sheet or my assets and liabilities look like after this purchase? And how does that impact the rest of my picture? And so Daniel can talk to a little bit about one of the tools we put together to look at what is the true cost of this purchase. It's not necessarily as simple as saying, hey, my principal is this and my interest is this. Cool, let's move in. There's a lot more that goes into it than that. So I'll let Daniel talk a little bit more about what goes into that process.
Yeah, so my wife and I are in this exact situation. We rent right now in the city, but we're looking to buy. And the purchase price of a home is one number. But in the city especially, we got to take into account a lot more factors than just, hey, what's the principal and interest going to be? And okay, let's say we want to buy a $500,000 3-bedroom home. What does that look like when we talk to Johnny in terms of, hey, what's my principal? What's my interest? What's that monthly payment? Let's say it's $2,250 a month, maybe, depending on where interest rates are for this given home. We're also trying to help people factor in, hey, what are taxes going to be? What's the HOA going to be? What are assumed, utility costs to live in a home like this? Depending on the school district, would I have to send my kids to a private school? So those are all factors that we consider part of the true cost of buying a home. And the other thing that we're trying to take into account for our clients is, hey, where are we taking the money from for that down payment? If Johnny helps us get to a number of, hey, we want to put 3% down or 20% down, where's that money coming from? On the slide on the screen, we're trying to avoid people pulling from their retirement accounts to fund this home purchase, right? Those are long-term assets. We're hoping that they have a cash reserve set aside, or maybe some equities that have been invested for a couple of years that they can use to fund this home purchase. But really trying to help people think about two things: the down payment amount, and then what is that monthly cost going to be for the time that you own the home. And hopefully it's helping people think about and evaluate, hey, should I move into a new home, or the rent versus buy conversation? We've been fed a lot of information for a long time that buying's always better, or in a city renting's always better, but those aren't really true for everybody. There's unique situations, and for a lot of people, to buy a home is an incredible investment, and that's what they should do right away. And for some people who may live in the city for only 1 year, renting makes sense for now until they've put down roots in a more permanent place. So those are some of the conversations we're trying to balance out with our clients.
Yeah, I love what you said there, because time horizon is so important, right? It's time horizon. And also, what are you purchasing? So you might have a different line item for maintenance repairs if you're buying a brand new townhome versus a 120-year bungalow in Wheaton, and putting some thought behind that and what your true maintenance and repair budget should look like. Or what does your CapEx look like? How often do you have to change out a roof? Is it, are people thinking about that? Are they putting money aside? And this is a really good conversation, because I see investors do this well better than just a homeowner. Like a homeowner, very rarely are we having these conversations. With an investor, this pops up like, okay, I have to change the roof and I know that. So how does that make my numbers look? There's no reason why a homeowner shouldn't be doing that same type of analysis, because when that bill comes due or when that roof starts to leak, that's on you to fix. And if you don't have the proper reserves to do that, you're not understanding what the true cost of the home is. And to your point, doesn't mean it's a bad decision, but you need to know why, eyes wide open, of what you're getting yourself into.
Yeah. The other piece we're trying to help people solve is, sort of that rent equivalent. So let's say you pay $2,500 a month in rent right now to be in a 2-bedroom, either in Wheaton or in the city. Depending on how long you live in that home, the actual cost of living that home is hopefully going to come down over time on a monthly basis. Because as Johnny will tell you, you're getting more principal the longer you live in the home, less of it's going to the interest. Hopefully you're getting a little bit of market appreciation. But you're also, if you do a repair or you do a new roof, hopefully you get some of that value back out when you sell the home in the future. So like everyone's been saying, we're really trying to help people understand the time horizon that they're going to live in this home. And then Mike, maybe you can talk about like, hey, should I buy a starter home first, or is it smart to just go straight to the 3 or 4 bedroom? What have those conversations look like?
Yeah, that's a great question. So there's a cost to moving, right? That's another one of those items that people might not look at. And what I would say first is, no matter what, you need to feel comfortable with the monthly expense that you're getting into, whether that's a starter home or not. So to say I'm going to stretch for the 4-bedroom that I can't really afford but hope to afford soon because we want to cut out a move in the future, I wouldn't say that's a very wise decision. But looking at it to say, hey, look, when you go to sell a home, there are expenses. You're paying broker fees, you're paying transfer taxes, you're paying all kinds of different fees to do that. And so you need to build that in and understand what those are. And there's just a pain of moving as well. Some of the decisions around buying a home aren't just, dollars and cents. This is a functional item for you, and your family wants to enjoy it. If this is not an investment, but your personal residence. So there's the dollars and cents, and there's the function as well. And so understanding what's the value for your family, how are you going to enjoy the space, those are very personal decisions. So I like to help people understand the pros and cons and help people pose those questions just as you did, Daniel, because there's not a right or wrong answer. It's understanding what situation you're in, helping them understand that there is a cost to move, and that might be okay. And you don't know what the environment's going to be 5 years from now. So are you okay if there's 4 years in a row of 10% appreciation, which isn't healthy, but we've just lived it, and you might not be able to afford your next home? I don't know. Like, we don't know. So just going in, understanding on day one, you can afford what you're buying. That's the most important thing. And Johnny and I have had conversations about this. We don't want people to say, look, this is a little tight now, but I feel like rates will go back down, so I'm going to refinance. We don't know that. We don't know if they're going to go down. Now, on the flip side, I tell people that don't really stress too much about rates. You want to afford it on day one, but if they go up, great, you locked in a lower rate. If they go down, yes, you can refinance. So Johnny, how do you advise people on that as far as, maybe they get approved for way more than they're willing to spend. How do you have those conversations with people of, maybe when they're up against their limit, what they should consider when making that decision?
Yeah, I mean, you're right on with the interest rate conversation. I tell them, obviously don't bank on things going down. I am kind of a, I don't know, eternal optimist. Maybe I shouldn't be, but I do have some inklings or some feelings about interest rates coming down some point in the next 12 to 24 months, which is encouraging. So I usually kind of give I do think this is a temporary little bit of a high point. I hope that's correct. But yeah, you got to be smart about purchasing such a big purchase, especially in this time. But if you take a look at some graphs further down here, the type of market we are in is pointing towards technically a recession. And I don't ever say that word to scare anybody, because I think without enough education on my part, a recession scares me. It's like, oh my gosh, this is terrible. But really, the definition of a recession is basically just, tightening the purse strings a little bit. Hey, things are more expensive. We got to cut back a little. And that's part of the economic cycle. If you look at housing throughout recession periods in our history, what happens? Interest rates typically on mortgages goes down. So the way you look at a recession potentially coming, and the reason I come to that is what's the 10-year treasury and the 2-year treasury. So the 2-year treasury is the short-term investments. The 10-year is the long-term. That is technically in a inverse yield, meaning investors are more skeptical about the short term than the long term. Things are very expensive. That is an indicator when that is in an inverse yield. A lot of times that leads to a little bit of a recession following that. And with recessions come a decrease in interest rates. So I'm giving that as kind of look at the history, make your decision, Mr. Borrower, Mrs. Borrower. But from what we see over the past 20, 40 years, we've had these inverse yield curves, leads to a recession. Interest rates have come down in those examples. To your point, Mike, going away from interest rates into, okay, fine, interest rates go down, but a recession sounds terrible for buying a home, right? That sounds so bad. I think you have some information that shows that it's not necessarily true, correct?
Yeah, so I'll answer that question, but I think you bring up a good point. So out of the last 14 recessions, we can't talk with 100% certainty, but the last 14 recessions, each of those instances, when they try to spark growth to try to get out of that recession, rates had come down. They use rates as a lever to do that. Now, the interesting thing about why there's maybe more uncertainty right now is we might have negative GDP growth and high inflation at the same time. That's a little bit of uncharted territory. We've seen it before. You've heard the term stagflation, but when you're trying to manage both those at the same time, it gets a little bit convoluted. So if we can somehow get inflation under control, then I feel really confident those rates would go down considerably, because that's just how they've handled the situation every other time, the last 14 times. So I do agree with you. And I also would say too, to your point, to answer your question, is 3 out of the last 5 recessions, home values went down. 2 of the last 5, they went down. 3 out of the last 5, they did not go down. So it doesn't mean that home prices come down because we're in a recessionary environment. We just don't know. So piggybacking on that a little bit, I'm going to scroll up here. Just to I want to ground everybody on kind of where we're at in the housing market and then where I think we're going. So this larger graph is kind of a picture-in-picture here, and that's by design. This is showing home prices, an index for home prices. You can kind of see how things shot up through the roof, starting really in 2020. And then the corresponding owner's equity. That makes sense, right? So as home prices go up, you increase your equity in the property. The reason I bring that up is when people are looking for distressed properties to hit the market, or at least over the COVID timeframe, they thought we were going to see a ton of foreclosures. That just did not happen. There was literally the lowest number of delinquencies we've ever seen. And the truth of the matter is to win a house over the last couple of years, you got to be a really, really strong buyer. The average credit score of the last 2 years was 750 versus 2008 and 9, when things went down the drain, was under 700. The loans that people were given there it was just insane, the lending standards. I know Johnny could speak more to that versus now. And also we've had the run on appreciation. So that's not to say you can't lose money on a house. You absolutely could. But if you own a house for more than the last couple of years, you probably have a good exit strategy, which means you're not going to have to go into foreclosure. You'd have an opportunity to exit your property, maybe downsize. So that's where we're at. People have record equity in their homes. Home prices have shot up through the roof. And now what we're seeing is a shift in the market. So we're absolutely seeing a shift. You can see here, this is showing you the percentage of properties that need a price reduction in order to sell. And you can see, I will tell you, the feel on the ground the last 4 weeks is completely different than just 2 months ago. We had houses that backed up to each other. We started to market one of them 3 months ago. We had 53 showings, 12 offers. Very similar house we started marketing 2 months later. Last month, we had 12 showings, 2 offers. So it wasn't the end of the world. They both got a great price for their home, but you can see how just in a 2-month span, the demand was considerably different. And so you can see how this is trending way up. Now we're below what you would see in a quote unquote normal market pre-pandemic as far as how many properties need to take a price reduction. But given the trend here, we could be up here at the 40% range in a couple of months. That's really what I'm looking for, is how much is demand going to pull back as people are managing their budgets and inflation and the cost of gas and everything else around them. So this is what I'm really watching here. We mentioned some of this, but we're coming out of this really crazy low supply environment where we had high demand. And here are some drivers. On the left side, you see the drivers of low supply. On the right, you see why we had such high demand. But in a nutshell, we had low supply because we had a gap in new construction. So once the 2008-9 housing crisis happened, a ton of builders really backed off, which makes a lot of sense. They're not going to build and put new supply into the market when we had all the foreclosures out there. And a lot of those people went out of business, got out of the business. They started building much less. So we have this gap in new construction of what was projected or needed to get built versus what got built. So that put us in this perpetual seller's market for the last 7-8 years, which is the length of a normal real estate cycle. But we've been in this environment for such a long time. And then COVID exacerbated the issue. But we have the gap in new construction. We have investors that have doubled their portfolios over the last 2 years. So when you think about that, they're buying a property but not releasing one back into the market. So it truly is eating at supply. And then we've also had an increase in household formation. So the housing market doesn't necessarily travel with population growth. It's more household formation, meaning how many households are needed. So if you have a 28-year-old that's not moving out, that's one household to 2. Or if you have, unfortunately, a divorce situation, you go from 1 household to 2. That impacts how much demand is out there. And now on the flip side, demand was so high because interest rates were so low. We had millennials in the housing market, and we had baby boomers trying to downsize. In addition to that, you had the workplace shifts with COVID. So that really put us in this environment that we hadn't seen in really since we can go back and measure. I mean, this has just been an incredible environment where you have negative real interest rates and you have low supply. So that's where we're coming from. But this is really what we're watching for to understand what's coming up. Jack and Daniel, you probably watch this pretty closely, or you maybe are experiencing it with your customers, because point 3 here is really what I'm watching. There's some numbers around personal savings rate and how it's just gone down to record lows. And then the amount of credit consumers are using has gone way up. So to me, this is a bearish view on maybe what's going to happen with housing. I don't think things are going to crash. Let's get that out there. I think it's going to level off. But if people are truly saving less and have more on credit, that can't be a bullish thing for the housing market. Don't you agree?
Yeah, exactly. Yeah, I mean, we try to always help people be planning for, any environment where they would, need to use their savings before hopefully utilizing credit. But when you see savings rates going down and credit usage going up generally, it's generally a bearish indicator, and people just probably aren't going to be in as, rich of a situation to go buy a new home if they're trying to make ends meet because of inflation or wage growth goes down or something like that.
Yeah, I totally agree. So I wanted just to share a few points as kind of like what to remember as we go through this market shift, because it's definitely a shift. Now, I don't know if that shift means pricing is going to appreciate less quickly, meaning prices will still go up, prices will flatten, or prices will come down. We just don't have enough information yet. However, what I would say is a real estate cycle is really normal. So we can't operate in this environment too long where we have this high appreciation. It's not healthy. you'd have a 1,200 square foot bungalow going for $1 million next year. You just can't have that year over year compounding appreciation. So from that standpoint, it's a really healthy thing to see a shift. We really probably needed to see a shift much earlier. And a healthy cycle is going from a seller's market to a neutral market back to a buyer's market and kind of going through that cycle. So from that standpoint, this is healthy. Now we'll see where things shake out. Ideally, we would land in that neutral market for a given period of time before going into a buyer's market. We'll see how this plays out. The environment is very, very different from 2008 and 9. There's really not a lot of correlation. Doesn't mean prices wouldn't come down. It's just not correlated with where supply is, where demand is, how much equity people have in their homes, the strength of their, as far as like how much equity they have in their homes, how much they put down, the percentage of long-term fixed debt versus ARMs, all that is completely different. So I don't see a ton of correlations there. And then I would just remember too that you can insulate yourself a little bit through these hard economic times if you're buying a house in a great area with great schools, with great parks, with infrastructure. It's still about location, location, location. So as the market changes, what we've typically seen during these times when the market gets challenged, we see a little bit of contraction where the top end really struggles, but the affordable houses around the average trading price continue to do pretty well. And then the houses with the best locations continue to trade well. So I would just say, as you're thinking about your home purchase, you're planning it with Jack and Daniel, you're talking to Johnny, it's about where you're buying a house, and you're going to start seeing some diverging storylines based on where you're at in the country, where you're at as far as infrastructure goes, and how those markets perform. So Johnny, what would you say would be, if somebody's interested in, understanding the cost around a loan, what would be next steps? How do they get a hold of you?
You can get a hold of me. Probably have my information somewhere on here, right? Give me a phone call. Well, I'll get it there.
I think you're Googleable though. You just Google them.
Well, yeah, we'll throw it on there somewhere. But just through a little information. I love having kind of a new buyer consultation. This is kind of the meat and potatoes of it right there. Is what I call the 3 pillars of qualifying, and the third is kind of an A and B, debts versus income, debt to income ratio. So typically in a 15-20 minute conversation of, hey, do we have credit reports and credit scores that will allow us to qualify via lending guidelines, which, like you said, are much different than they were in 2007, 8, 9 leading up to the disaster. So credit report, do we have something for a down payment? Get it out there. It doesn't have to be 20%. Some people still think it does. It does not. We have conventional loan options as low as 5%, potentially 3%, depending on income levels. FHA at 3.5%. So low down payment options. You can look at down payment assistance programs, a lot of different things. All we really need to do is cover that basis and we can, make it happen. And then the third is really where you actually qualify at, is based on your debt to income ratio. Where can you actually afford that monthly payment? And my job is always to change the conversation from a purchase price to a monthly payment. That's what we're qualifying on, is a monthly number. So, $1 million purchase for someone putting $500,000 down is much different than someone putting $200,000 down. The loan amount's different. If your credit score is different, your interest rate is different. So we have to break it down to a monthly, what that equates to on a purchase price versus what's my purchase price I can qualify for and the interest rate. It's a little bit more detailed than that. But those 3 things put together, and we can kind of have a good idea of our qualifying ability, and then go from there. And then the conversation kind of changes typically from, how high can I qualify for? Or it goes down the other route of, hey, sky's kind of the limit here. You're a great buyer. We've got all kinds of options to qualify. Now it comes back to, what is the actual budget that's right for you and your family moving forward, which is then why typically we try to, push that to a professional like Daniel or Jack to get all those other pieces of the puzzle, planning for retirement, all that other stuff, for them to really lead in. Yes, you can qualify for that $2 million home, but is that the right decision? Let's make a real blueprint pathway for your overall financial picture.
That's awesome. So Jack and Daniel, any parting words of wisdom for the group out there? How do they get a hold of you? Any next steps that you would recommend?
Yeah, to jump in there, it's just, I think, important to note that in 2022, almost all parts of your financial life can be done with technology by yourself. And speaking from experience here, I worked personally with Mike and with Johnny for my home purchase 2 years ago. And I can say with 100% certainty, it's better to go through this process with a team than by yourself. Yes, is it possible to do it just with online solutions? Yes. But to have Johnny walk you through the pros and cons of different mortgage products out there, and to go do a bunch of showings with Mike and the rest of his team, it's invaluable, as opposed to trying to just do it by yourself with Rocket Mortgage and Zillow online. So can't say enough about doing it with partners that you trust and have a relationship with. And yeah, it makes the process a lot more, gives you a lot more clarity, a lot more comfort as you go through it. So yeah, you can talk through about how to get in touch with us.
Yeah, you can get in touch with us via LinkedIn or O'ConnorFinancial.group. We're always happy to buy you a coffee and have a conversation. The one thing that I would add is, you can always be planning. So for my wife and I, we thought we were going to purchase a home. Johnny did a really good job trying to get us a loan on some of these homes, and we lost out in bidding wars. But we're going to spend the next year working with Jack as our advisor and planning for, hey, what's the next purchase going to be? How much more can we be saving this year before we make that purchase? If you're already a homeowner, you can be planning for, hey, what's my exit strategy going to be? You can talk to Mike and say, hey, what's the equity in my home? How much could I sell my home for if I want to downsize in the future? Or if you're a first-time home buyer and you say, hey, this conversation is a little far out for me. I don't want to buy a home for maybe 3 years. I don't have a family yet. This is the best time to be planning for your home purchase. If you can take advantage of, having time on your side, having some income you can be saving and investing, you can really be well prepared for this conversation, as opposed to, you find the right home and try to scrap together the dollars on the back end. So we're always happy to be helping and planning for this conversation.
Love it. Well, thank you guys for joining. I think this helped me, so hopefully it's valuable to our networks, and we'll do this again soon.
Beautiful.
Thanks. All right. See ya.